Philippe Gijsels, Head of Research for BNP Paribas Fortis, welcome to First Look. And European PMI manufacturing services data actually expected to show some further improvement today. ECB injecting an unprecedented amount of liquidity into the market. Is it time to buy peripheral bonds such as Italian, Spanish bonds?
Well, I think they already had quite a run now first on the data, and it will be very important to see where they're going to be, because these data are sitting around the 50 level, which is the barrier between expansion and contraction. So first of all, it will be very interesting to see what the Eurozone is going to do. On the investment side, on the bond side, we have seen that Italian bonds and also Spanish bonds have done already quite well because of the liquidity, because of the better sentiment. So we will have to see. I think in the short run, most of the gains have been had, and if there are new problems in the second half of the year, maybe around Portugal, maybe we can even see some profit taking on these.
And Philippe, I wanted to talk about that market pressure easing, because as you say, we have seen borrowing costs come down a bit for the Spanish and the Italian bonds. Is there concern now, with all that money coming from the ECB, that this could allow some countries to start missing some of their austerity targets? We've already seen some fiscal slippage coming from Spain.
That's clearly the case. So the central bank put quite a bit of money in the system through LTROs, which is in a way quantitative easing. So that lifted all boats, made interest rates come down, and then reduced in a way the pressure on these countries to make the necessary steps. So it was always the delicate balancing act between helping them but not helping them too much in the short run, because then the austerity measures may not be taken. And we have seen some slippage, and let's hope that the governments are firm and then they continue with what they have promised.
Has this money then being injected by the ECB just bought some time? Has the bailout of Greece just bought some time? Because you think actually that Greece is unlikely to meet its 120% debt to GDP target for 2020.
Well, indeed, that's clearly it. The ECB has bought quite a bit of time now, but in that time it should be used, of course, to take the fundamental, the structural measures that are clearly necessary. And a lot of people doubt indeed of Greece will make that 120% debt to GDP target by 2020. It will not be a picnic, that's clear, and also other countries are still struggling. So the most important message is probably that the time should be used well to get structural reforms going. And if that's the case, and we see the economy picking up in the second half of the year, I think that the rally in risky assets after some pause, some correction now might resume. If not, we risk more or less a repeat of what we saw last year, when the beginning of the year was very strong, but we got problems in the summer and the autumn.
I see. And how much, therefore, as we start to gather pace potentially in returning to growth in Europe, how much of a concern is inflation to you? Because at the moment we've got really near record low interest rates for the ECB, don't seem to be going anywhere fast. But we do have a two-speed Europe here, Philippe. We do still have Germany showing signs of growth. Would it need to start to see interest rates go up? Can in Europe enforce fiscal consolidation quick enough?
Well, that's a very important point. Now, in the short run, we do not think that inflation is a problem because economies worldwide are more slowing still. China is slowing, so we see inflation coming down over the next couple of months and quarters. So, but eventually, you could argue that with putting all that money in the system, that could be inflationary down the road. And also, indeed, like you argue, Germany, of course, interest rates are still way too low for Germany. They should probably be higher, the short-term and the longer-term interest rates. So if they stay at these levels, we already see house prices in Germany going up, some pressure on wages, so that might become a problem somewhere down the road, but I would not see it immediately for the next couple of quarters.
So you mentioned earlier that we could see a return to appetite for risk going forward, but we have Timothy Geithner-Bernanke speaking to Congress just yesterday, and both highlighted the risks remaining for Europe, as you too have been mentioning. And it seems that banks still need strengthening. That is what Bernanke's calling for. Do you agree? Are we still on track for more strengthening from the banks, and are we still beset with weak growth in Europe?
Well, I think that the banking sector already made quite a bit of progress in Europe. But it's not already that far as in the United States, where you saw that the last stress test was fairly good, even with very harsh conditions. 16 of the 19 banks passed the stress test in the United States. In Europe, we're earlier in the process, but I also think that what the ECB has done with the LTROs, provided liquidity to the banks and giving them opportunity to make some money on carry trades from that, that gradually things will improve. But indeed, there is also still some work to be done, probably.
Philippe Gijsels, Head of Research at BNP Paribas Fortis. Thank you for all your insights and looking ahead to the European economy.